Hello everyone. My name is Nathalia Sá, and today I have a huge honor to have here with us Joseph Filicetti. Joseph, you can correct me later, but I try to say your surname. And as usual, I'll show some slides presentations, and then the floor is all yours, Joseph. Thank you. So first of all, here are the previous episodes. So if you want to watch any of them, just scan the QR code with your camera's phone. And here, there is 3 ways so you can invest in Western asset macro strategies, the fund that we are talking today. One way is directly in this fund. Secondly, you can invest through selection multimercado global. That is a fund of funds that focus on the best hedge funds in the world, as our opinion. And then there is the third way that you can invest through one of the DNA funds. That is a whole portfolio in just one fund. Okay, so you can just scan the QR code and you have more information about all them. So I will just briefly show here the historical performance of the fund against our benchmark, that is CDI, right? Is the Brazilian basic interest rate. So here's the fund since the beginning in Brazil. But other thing that is very important to look when we analyze funds, international funds, so we have to look to their benchmark, right? So here there is the historical that it's bigger, it's longer than our Brazilian fund. And here is since 2013. And here these 2 classes, right? And against benchmark. So since inception, the fund is really with a better performance than its benchmark. And one thing that I would like to explain just briefly, because the performance of the fund that we access outside Brazil, it's not the same, is because we have this, that it's called the hedge structure. So we have like the fund return. Here is just like an example, but you could you could change it for any funds outside. So you have like the fund return less cupom cambial and plus Selic CDI. So that's why we have a huge return. We have like this beneficial for them because we have like our basic interest rate is really hard. So here's just an example, but if you want to understand it in a deeper way, you can look at our report explaining all that. But we are here to talk about Western, and that is one of the biggest houses asset in the world. Was one of the most recognized. They have like more than 100 analysts to support its thesis. But I will Joseph tell us a little bit more about the portfolio managers and Western history. So thank you again, Joseph. You are muted.
Thank you. Sorry about that. Well, hello, everyone, and thank you for taking time to join today. We appreciate the opportunity to talk to you. So I want to just kind of introduce the fund, macro opportunities, and I think there's 3 things that I wanted to make sure that we talked about when when I think about and talk about macro opportunities, I think first and foremost, it's a distinctive and a flexible approach. And by that, I mean, you're going to be getting concentrated exposure to 2 or 3 key themes at Western Asset. We never talk about macro opportunities as being a best ideas fund, because if you did, you could only have one fund. But we do a lot of unconstrained investing. In macro opportunities is the one that we go for the largest returns. And so we give concentrated exposure to some of the key themes at Western Asset. And I think the interesting thing about that is that you have the ability to direct these exposures opportunistically toward strong segments of the market. And so as things change, and this year we've seen a lot of change with interest rates in the United States and around the world as the fear of inflation has really taken hold. And we saw interest rates rise a lot early part of the year, and then they rallied tremendously into July. And so now we have a very unusual situation where you've got front end rates, very high, and then longer dated rates very low. And so we're able to take advantage with this distinctive approach. We're really able to concentrate on these value opportunities. And then I think the last thing I would say about this distinctive flexible approach is it's not dependent on the direction of interest rates to be successful. So normally when you have a fixed income fund, if you're lucky enough to own it when interest rates are declining, generally that's a good thing. But the long-term track record, which goes back to 2012 when we started the strategy, is that when rates were zero, the strategy did very well. When rates were rising in 2016, 17, and 18, the fund did very well. When rates were falling in 2019, the fund did very well. And it was even positive in 2020 during one of the worst economic contractions in 100 years. So we do think this is a really flexible, distinctive approach to the fixed income markets.
That's great. That's great. Thank you. Thank you for the introduction. It's really one thing that the investors actually ask us a lot about when we look to Brazilian hedge funds. It's how they are correlated with interest rates. So it's good for you it's good for us that you could analyze this. And if you could talk now about the background of the portfolio managers.
Yeah,
then
so
we continue with the structure of the fund later.
Yes. So the portfolio managers, the lead portfolio manager is Ken Leach, and he is our chief investment officer at Western Asset. He joined Western Asset in 1990, and he became the chief investment officer in 1998. Now his specialty is trading interest rates and trading options on interest rates. And so that's really what he brought to Western, which at the time when he came to Western in 1990, it was really just a credit shop. So we would say, in those sectors, we like those particular bonds. And so when Ken came, we added this macro perspective, and we were able to say to look at fiscal and monetary policy and liquidity and inflation. And in those, inflation, the inflation story today is really what's driving markets. It's what's driving the Federal Reserve. And it's one of the biggest stories other than COVID in the markets today. So these very large macro factors being considered and being evaluated and being included into the decision-making process at a very, very intricate level makes a lot of sense. And so I would say the predominant risk that our fund takes is macro, and so that's Ken's specialty. Now he's helped. We work on a team-based approach, and he is helped by Prashant Chandran, Prashant is our global head of derivatives, and he joined the firm, I believe, in 2007. And since 2012, both Ken and Prashant have always been the only portfolio managers on macro opportunities. So Ken is the lead portfolio manager, but Prashant works with him every day on every aspect of the portfolio. So if Ken were out, if he were traveling, or if he were on vacation, was not trading the portfolio, Prashant would be able to trade the portfolio exactly as Ken would in Ken's absence. And so we have complete duplicity. And I would say that they both, I mean, obviously, Prashant's expertise is in global derivatives. And I think they work very, very well together. They're very good friends. They've worked together on other portfolios. And we feel very comfortable that this team has, a tremendous amount of experience, which is why we, it's one of our flagship strategies at Western Asset.
Thank you. And what about the asset management history?
So Western Asset, like I mentioned, it started in 1971 in California, and at the time it was just U.S. based. And I believe it was 1985 when Legg Mason bought Western Asset. And just as July 31st of 2020, Franklin Templeton bought Legg Mason. And so Western Asset is a fully owned subsidiary of Franklin Templeton. And this is a very strong relationship. Today, Western Asset has offices. We have a large trading desk in Sao Paulo. We've got one in New York and Pasadena, California. We've got one in London, Singapore, Melbourne, and also Tokyo. And I think what's very interesting about our firm is that, and this is really important for macro opportunities, is that we work on a team-based approach. And because we have billions of US dollars being traded in every one of those offices I mentioned, we always, and we're in absolute communication with one another, sharing views about the global economy, about the macro economy. But more importantly, you've got people, for example, with respect to the Bank of Japan, where we've got local people in those offices that have deep relationships with insurance companies and the central bank, and also the government. And so they're in a terrific position to give information that really helps the trading. So we like to say, at any point in time, we always know our strongest ideas around the globe, because we really do share information. And it's a really powerful statement. When we put macro opportunities together, we thought if we just took one or two ideas from around the globe and created a macro offset to those ideas, you would have a pretty strong portfolio. And so today, that's really what macro opportunities is. It's the most aggressive strategy we have at Western Asset. Our chief investment officer is the lead portfolio manager. So Western Asset is very committed to making sure that macro opportunities has the support it needs to be very successful.
That's great. Can you explain a little bit more how the investment process works? So how you decide for one position or another, how the whole process?
Sure. Well, so like I mentioned, we work on a team-based approach, and there's a committee called our Global Investment Strategy Committee. And this is a very important committee at Western because it is the group of people who sit in those local offices that meet once a week by phone to look at the world from a very macro perspective. And so they're looking at fiscal and monetary policy, liquidity conditions, and inflation. And they're coming up with a view on Brazil, and the central bank, and what's the prospect for the central bank to continue hiking rates or not. and Bolsonaro's administration and how successful or not they have been in implementing, their agenda. So all around the world, this group forms very strong opinions, and we look for opportunities. Now, these are generally longer term views, but from these ideas, some ideas, are particularly attractive. We always know, for example, if we prefer U.S. duration to European duration. We have a strong view on the central bank, the ECB, and where Christine Lagarde and her advisors are taking European interest rate policy. And so we look for relative value ideas. We look for outright risk-taking ideas, and so that's really how the idea generation happens. Now, Ken and Prashant, as portfolio managers for macro opportunities, they really have two main responsibilities. Their first responsibility is to select which key theme of Western asset will go into macro opportunities. What will you get concentrated exposure to? That really is up to them, but their selections must come, from our global investment strategy committee. So it's not like Ken and Prashant can come up with their own ideas. So they're really expressing strong views of the firm, and so that's the first responsibility they have. I might add that right now we really like investment grade credit and high yield in reopening trades, right, as the global economy reopens. So there's been a big emphasis on energy as the global economy reopens. But we also like investment grade credit because our view going forward is that growth and inflation are going to moderate. And we think in that kind of an environment, underpinned by a lot of central bank policy, spread product, investment grade and high yield credit should still outperform sovereign debt. The other concentrated position we have is in emerging markets. In there, we feel there's a tremendous opportunity, but I'll talk about that more when we get into the idea to the view going forward. But so Ken and Prashant really are responsible for selecting which key themes go into the portfolio. The second big responsibility that they have is to create the macro offset to these longer term views. Because they're longer term views, you're going to be offsides at some point. There's going to be some times when your portfolio is losing because you have this longer term view. It's especially during those periods we lean on our macro skill set, which to us means duration, curve placement, if we're playing for a steeper or flatter yield curve, and then volatility management around all of that. And so those are the two big responsibilities. And I think the expertise of Ken and Prashant in particular really rests in interest rate risk management. And that's the macro calls. That's why they were both chosen to lead macro opportunities, because the interest rate risk management is so very important in this portfolio. I would say that on average, every year over the last 10 years, we've had about 10 years of change in the effective duration of the portfolio. And that comes from a repeatable process. So you think about it, that's a tremendous amount of variability in your duration. Yes. One of the wonderful byproducts for the investors is that if your duration changes 10 years in a year, you will have a low correlation to other segments of the fixed income market. I mean, there's almost no way you couldn't. That's not the reason that we do it, but it's a nice byproduct for the investor. But those are the two big responsibilities for Ken and Prashant. Once the macro call has been made that we think the environment for investment grade credit, and so for example, energy, once that call has been made, then we turn to our energy analysts and say, what in that sector, in investment grade credit, what names does Western like? And so Ken and Prashant are not picking individual names of companies. We leave that up to our analysts. They're the ones that do all the bottom up work, all the idiosyncratic factors, in the energy sector. So, we have analysts that focus on every major fixed income component around the world. So we have analysts that only focus, for example, on Latin American emerging markets, and or analysts that only focus on mortgages and structured products. And so anytime there's an idiosyncratic decision to be made, we really rely on the analysts at Western for their work. But the big macro calls are being made by Ken and Prashant and the Global Investment Strategy Committee. And then Ken and Prashant are fine-tuning, the exposures. So whether we have 23% in investment grade credit or 22%, that would be Ken's and Prashant's call. But not like which individual bonds we own. That we rely on our analysts. And that really is how trades get into the portfolio. And Ken and Prashant really focus a lot of their time on trying to get the big picture macro view correct. What do we think, what general direction of interest rates is going to happen? What's the general view on inflation relative to where we are right now? So it's a very team-based approach. And I think because all of the people have worked here for so long, that they really work well in that kind of an environment. Certainly not every place works on a team-based approach, but I think the people that have been here at Western for a long time work really well. They share information. And I think the benefit to the investor is that you have a tremendous amount of expertise, at your fingertips. So it's a very good team approach, I think.
Sure. Very nice. And to illustrate the top-down approach or analysis until you choose a position, can you illustrate it, telling us one or two positions that was successful that illustrate this process?
Yeah, I think being short the US dollar in 2017 was very interesting, and it was a very good position for us. And it was definitely counter consensus at the time because at the time, the Federal Reserve had started raising rates. Janet Yellen started raising rates in December of 15. I think they got in two rate hikes in 2016. We got through Brexit, and we got through the surprise Trump election in late 16. And so in 2017, our view was that the global economy would do well. And really that had been our thesis for a while. And here's the thing, is that the Fed was raising interest rates, and a lot of people thought you're going to have a higher rate structure in the United States and the dollar should do well if interest rates are rising. But actually the opposite happened. And the reason that the Fed did raise rates 3 times in 2017 and the dollar weakened. And the reason was because you did have the global economy really from the first time since the global financial crisis did better than the United States. And so we really feel that it's not so much the overall level of interest rates that's going to drive the dollar, but it's really, global growth versus US growth. And if you think there's an opportunity in emerging markets and in the economies outside of the US, you can take that position. I mentioned this position because right now, we're mild dollar bearers, because we do think that, and I know it seems very dark right now because we've got a lot of problems with COVID and now there's Omicron. But we don't think it's always going to be like this. And, I'll talk about this later. If you think about global equities up near all-time highs with all the problems that we have, and you think about global credit all across the developed world at very tight spreads, again, with all the problems that we have, then you think about emerging markets and those things have not recovered at all compared to equities and credit. but if you think forward,
Yes.
6 to 12 months, with greater progress on vaccinations, and maybe a petering out of the fatality rates that we've seen, with Delta variant, and better therapeutics and medicine and more vaccines, you could see a recovery taking place, and you have such a differential in real yields between emerging markets and developed markets. We think that as people gain confidence in the developed market recovery, that increasingly they'll look to emerging markets. So that's an area that we really like. But so I mentioned that being short the dollar in 2017 was an example of a good trade, that we did.
Great. And what about a position that didn't do so well as expected, or one that you have learned a very important lesson from?
Yeah. So, we have plenty of those. I think, again, sticking with emerging markets, in 2018, and this was a very interesting time, emerging markets was one of the areas that we really liked. And it went through a very difficult period. In fact, the volatility in August of 2018 was higher than in EM than what we saw in the global financial crisis. And, I think the Trump administration in early August of 2018 imposed 20% sanctions on Turkey and then doubled them 4 days later. I mean, absolutely unheard of. And you took this idiosyncratic issue with Turkey. And at the time you had Argentina going through a lot of difficulties with Macri's re-election. And then you had Russia, and then you had South Africa. And so you started this, you took this idiosyncratic issue of Turkey and really kind of made it systemic for many emerging markets. And so we saw a tremendous amount of volatility. So, I cite that as a difficult period that we stuck with emerging markets. It was a negative performance during that period, but we were able to hold on to much of the position. And it's very interesting that, as we turned the corner and U.S. growth and inflation really moderated into the end of 18, in January of 19, in the first quarter of 19, emerging markets did spectacularly well. And so it just shows you that, you do have to have a longer term view, but sometimes you have to sit through some painful periods. But I'd say August of 18 with emerging markets was a difficult period for us.
Okay, so we talked a lot about past. Let's talk about future a little bit. So I'd like to understand what's your view about the economic scenario, and what about your view of the market, and if you could speak a little bit more about global inflation or US inflation. Is it transitory or not? What's your view about this new variant of COVID? So please.
Sure. Sure. Well, let's start with inflation because that's on everybody's mind. So
yeah.
So I think I'd come right out of the top and say, we think that inflation is going to roll over next year. And this would largely be due to base effects and improvements in supply chain efficiencies. If you strip down the core PCE or the CPI and you look at every one of the components in there, in almost every case, you can trace back higher prices due to scarcity, right? So you just have a supply issue. People are willing to pay more. There are just simply no rental cars. We don't have the computer chips for the cars. And so these higher prices caused by supply issues to us really only result in higher prices. We wouldn't categorize that as a self-sustaining inflation, because as soon, one day Avis and Hertz and budget rental cars they'll have enough cars, and you won't see this upward price pressure on rental cars, for example. That's very different from an overall inflation that's driven by demand. And so, we believe that really only a central bank can create the conditions necessary for a self-sustained inflation. And that you would need an excessive monetary policy. And right now, the Fed is tapering their purchases. In fact, they're accelerating their tapering. They're going to start raising rates next year. M1 and M2 have been coming down in the United States. And the multiplier effect, which is usually filled by bank lending, has been not grown at all. So we really don't have a multiplier effect in the economy. Now, there's no mystery why there's no bank lending going on. It's because of the Basel Accords, Basel 1, 2, and 3, Dodd-Frank here in the United States, and all the other capital controls that Congress put and the Federal Reserve put on the banks so that they would never get in trouble like they did in 2007 and 8. And this is not just in the United States. It's bank lending is kind of stuck in the mud in Europe and Japan as well. So all across the developed world, you see these capital controls really restricting bank lending. So we don't see that you have an excessive monetary policy right now. The Federal Reserve desperately wants to get out of the bond buying business because it really hasn't affected total spending. Total spending being GDP, right? So everybody's talking about the strong growth we've had this year. And that's a true statement. The United States did grow strongly this year. But what happened in 2020? You have to view 21 through the lens of 2020, because we had the biggest economic contraction in 100 years. So if you go back 4 quarters, US growth is over 9%. Is there anyone on this call today that thinks the US is going to grow at 9% next year? We certainly don't think that. And so when people talk about the annualized inflation rate at 6.8, again, you're coming off, one of the worst economic contractions in 100 years, and you have supply chain issues. And so we've reduced the supply of something, and so the price has gone up. That's very different from an increase in overall demand for goods, for all goods and services. For example, right now we have higher wages in the United States. Wages have gone up, but we still have 10 million jobs available for 5 million people. So even Chairman Powell yesterday said the inflation that we're seeing is not from not having any workers left, right? So we still have to clear 5 million workers back to work. And actually the price pressure, when you do that, would be down, not up. So higher wages are being offered, but they're not being taken up. And so that's reflected in our poor participation rate. It's been getting a little better lately, but we still have a poor participation rate. So I would say the first reason that we don't think we're going to have a sustained inflation is really because we don't think the monetary conditions necessary to generate a lasting inflation exist in the economy today. And that would be, an excessive monetary policy, right? Because M1 and M2 have been coming down. The Fed is going to be tapering their purchases very quickly. They're going to be raising interest rates. They're tightening financial conditions. The Fed's going the other way. And then the multiplier effect is not there either. The banking system is not increasing their loans. They're not multiplying the effect of whatever stimulus the Fed put in on the other side. And then you have to take into account the base effects. The second big reason that we would say is that just look at the back end of the US yield curve. 10-year notes are still 144 basis points. 144. If you were going to make the case that we were going to have a 6% inflation next year and growth was going to be very good, you would expect higher rates and a steeper yield curve. But in fact, we've gotten the opposite. We've got lower rates and a flatter curve. It's very interesting. Our chief financial officer, Ken Leach, likes to call the back end of the U.S. yield curve the Cassandra of all economic indicators, because Cassandra was the Greek goddess who was always right, but she was never believed. And so the back end of the US yield curve is telling a very different story from the front end. Typically, you don't see the back end of the curve flatten until the end of the rate hiking cycle. And the Fed hasn't even started yet. And so the roll down between a 30-year bond and a 10-year note is only 40 basis points. And so that's very flat. And what it's saying is that, what we believe it's saying is that growth next year will be only moderate. And we do think that inflation will be moderate as well. So I think that's the kind of the view on interest rates and growth. I would say that we like the emerging market complex. Our thesis is that we are going to move beyond COVID, both medically and economically. It's going to take some time, so that's talking over the next 1 to 3 years. But during that process, the Fed will start to raise rates. They'll complete their tapering early next year. They'll start to raise rates. And we believe that as people gain more confidence in the global recovery, these emerging markets haven't come back at all. But when they do, I think the returns there could be absolutely tremendous. If you think back to November of 20, when we got the news about the vaccines, and it was so wonderful to have that news, that was the only month that really emerging market debt and currencies really flew. I mean, they had a spectacular November. And so you can see when the sky's clear for the developed world, these mainly export-driven economies, can really do well. And like I said, when you think about global equities and think about global credit, if somebody had asked you to buy equities in April of 20, you would have looked at them like they were crazy. But yet you had a V-shaped recovery. And so we think that you can have, emerging markets has every possible bit of bad news priced into it. You've got all of the medical complications around poor vaccination rates, rough medical infrastructure, political instability. You've got the China slowdown priced in. Central banks, especially in Brazil, have been raising rates extraordinarily aggressively in anticipation of a higher rate structure in the developed world. And so all of this is in there now. And if you can look down the road, 12 to 24 months, if you see things getting better, what would that mean for the emerging complex? And we think from today's pricing, we think it really represents a big opportunity. So that's an area of the market that we really like. It's one of the two concentrated positions we have in the portfolio. The other one was in investment grade credit and high yield. And there we think in a moderate growth environment that spread product will outperform sovereign debt.
And when you say emerging markets, are you referring to Latin America? Are you referring to Asia, or both of them?
Yeah, so the concentrated positions that we have right now are in Russia for the energy exposure, Mexico for its proximity to the United States, and for Brazil because we think there's a real opportunity. We think they're much closer to the end of the rate hiking cycle than the beginning. We're receiving in short dated rates in Brazil. And we just think that, as a very large, serious exporting market that you have. And we think in a global growth across the developed world story, as that does better, we think that that's really going to help Brazil a tremendous amount. So those are the three countries that we have the biggest exposure to.
Right. And when you say energy in Russia, are you referring like the old kind of energy, like petroleum, the commodities, or do you have any thesis of the clean energy, like the whole world are talking so much about it now? So
yes.
If you could talk a little bit about this whole team, including the energy in Russia. Course.
Yeah, so the reason that we liked Russia really was in the spirit of a reopening trade. We were expecting higher prices this year. We were not expecting them to persist, but you want to have things in the portfolio that would have a positive response to an increase in inflation and an increase in energy prices. And so Russia's economy is certainly sensitive to the change. Their current accounts, they have a current account surplus right now because of the very high energy prices. They have more than $500 billion US in central bank reserves. They've got a very low debt to GDP. And so, this is from a fundamental perspective, there's a lot to like about Russia. And they've also been raising rates pretty aggressively. And so we think, their pricing relative to, a meaningful global economic recovery, that's one that we really like. Now, clean energy is something that Russia's probably not leading the world in right now. But again, there's a big push for this, and it's going to take time. But that's, we're always looking for opportunities to have those kind of green bonds in the portfolio where they're available. And so, that's certainly an area that we're looking at. And we do have some issues in the portfolio already.
And talk about bonds. Could you tell us a little bit more about your view of U.S. Treasury?
Yeah, so I think the duration in the portfolio right now stands at about 5.5 years. It's interesting that 10-year notes started 2021 here in the United States at 91 basis points, and when we got the news that there was a good chance early in the year that Biden would be able to get through his budget of additional fiscal stimulus, 10-year notes, and went in a straight line to 175. So from 91 basis points to 175 in a straight line, because we were going to have a big economic reopening and we were going to have inflation. That was not our view. And so, we were essentially long and wrong, in the first quarter of this year. We ended the first quarter with about 9 years of duration, because we had a pretty strong view that, 10-year notes were not going to go straight to 2% or beyond. And that, the economic reopening would just be a little bit more difficult than what was priced in. And so what you saw largely over the second quarter was this, very slow rally, really, that took you into the third quarter in the third week in July, with 10-year notes trading at 117. The effective duration of the portfolio when 10-year notes were at 117 was less than 1 year. So you went from having 9 years of duration with 10s at 175, and then they rally in price and in lower yields, and we took profits along the way. And at 117, we didn't think they were going to go straight to 1%. And so we had really lightened up a lot on our duration. And so this is a good example of this kind of duration management we do, this repeatable process that I talked about earlier. And so right now we feel that we're going to continue to get probably 2 more high CPI readings. So in December and in January, and then the numbers are going to start to flatline in February. In March and April, that's when we think you're going to see the big rollover in these inflation numbers. And so we are positioned. So you asked about, the duration positioning in the fund. We are positioned long in the front end, especially in the DEES 23 Eurodollars. And so right now there's 6 rate hikes priced in. So those things trade at a discount from 100. So they're trading at 98.30 today. So you have, 6 rate hikes priced in between now and December of 23. And so we're long those, thinking that the Fed will be able to raise interest rates, but not 6 times. So what we think is that the inflation numbers will roll over. The Fed will have accelerated and be out of the bond buying business by the end of March of 22. And then they're going to have a period of time before they need to raise rates. If inflation numbers are rolling over and growth moderates, we just don't think you're going to have a lot of votes to raise interest rates into that. Remember back in 2018 when the Fed, raised rates 4 times, and then they had to reverse a lot of those rate hikes in 2019,
Manifest.
right? Because growth and inflation didn't show up. They were starting point was 2.5%. So they had room to cut rates. But now when they get done with the tapering in the spring, rates are 0. If they start to raise rates too early and they make a mistake or they make a policy error and the economy can't take it because growth is slowing down, then they're going to be in a very difficult situation because they're going to be in a much worse situation than they were in 2019. So we think that the Fed wants to see these inflation numbers roll over. They want to take their time with the economy. And we think they're really going to focus a lot on employment and trying to have a broader based, more inclusive economic recovery with respect to employment. So this would include minorities, and it would include geographical areas that didn't participate after the global financial crisis. So with respect to employment, here in the United States, we had a very uneven recovery. We had a very small number of people that had a lot of the wealth, and it wasn't a broad-based kind of employment that was really shared by many. And so this is one of the goals of the Federal Reserve. And we think that Powell really and the other voting members really will want to address this. But right now, just looking at 4-quarter data, of course, the data looks strong, and the Fed sounds hawkish, and that's what their job is, to respond to the data. They're not in the business anymore. In December of 19, when we were at 50-year lows in unemployment, equities were at all-time highs, and the US economy was coming in at target, they were cutting interest rates. And that was so spectacular to them that made them throw their Phillips curve model out the window. They threw all their models of expected inflation out the window because clearly it was not working. And they changed their reaction function to go by realized inflation. And so that's what they're doing right now. If inflation is high, as it is right now, they're going to react to it. And so they've openly said, next year we're prepared to raise interest rates 3 times. And that's exactly where the market is. So we believe they have the market right where they want it. If the inflation rolls over, they certainly don't have to raise rates 3 times. That's our view. And so we'll see what happens.
It's a very interesting point of view. And I would like to ask you about how worried are you about this new variant of COVID, and connecting this Europe, it's kind of it's I don't know, we are kind of worried more about Europe in this context. We already see Germany doing some moves to close the economy, and then I would like to understand your view. And what do you think about German bonds too?
Yeah. So to your first question about Omicron, a month ago, it was just another letter in the Greek alphabet, and today it's a global concern. And Germany has shut down some aspects of its economy. We just yesterday instituted we're going to be out of the office until the middle of January. So it really could have an impact. And of course, this is turning out to be a pandemic of the unvaccinated. And here in the United States, we still have 40% of the population not fully vaccinated. And so, yes, if it's anywhere near as effective as Delta, it's going to be a big problem, and it will slow down economic recovery. But I think this is a terrific example of one of the things that we didn't foresee, but that you have to bake into your forecast that could be a headwind to growth. And we think those 6 rate hikes that are priced in today, you're pricing in close to perfection. And labor market recoveries and things like Omicron can come up, and they can really delay things. it's early innings right now with respect to Omicron, and I have not seen a lot of people that have that have died from Omicron yet. So it seems to be incredibly transmissible and highly infectious, but a lot of people that are testing positive are not having terrible symptoms. Certainly the people that are vaccinated so far have not had hugely detrimental results. So yeah, it's something that we're absolutely going to be watching, but this is one of the things that we would give as an example of why you want to be very cautious, and it's a headwind to growth. If it turns out to be like Delta, it's going to be very difficult. That said, in your second question was about
Germany bonds.
Germany. Yes. So we actually have we're actually short 6 years, a little over 6 years of German duration. And so we think that the spread between the US, so we're long US duration, we're short German duration. We think the spread between US and Germany is going to compress as both US and the European Union, do better. So we would expect that to compress. The Friday after Thanksgiving was when markets really sold off on Omicron. And that was the first time that we saw, it really being in the news, and you had a big treasury rally. And so treasuries rallied and German bonds rallied even more. So that spread between the US and Germany actually widened. And so we added to that trade. We had negative 3 years of duration, and now we have negative 6 years of duration. So we added to that. And again, longer term view, we think that as both economies recover, German bonds are going to ultimately, 10-year notes are going to trade positive there. And that spread between Germany and US should compress pretty significantly. So that's a trade that we really like.
That's nice. Well, Joseph, we are almost without time. So I'll just show again here. So to everyone, if they want to know more about Western asset macro strategy, the fund that we talk about it here is just to scan with your phone, your QR code. And Joseph, I would like to thank you so much for being here today, or your time explaining the fund, explaining its history, explaining what are your thoughts now and your positions. So thank you, really, thank you so much.
And thank you for putting this together, and thank all of you who are listening. We really appreciate the opportunity to speak with you and to explain our views.
Thank you. Have a good night and see you soon.
Okay, thank you. Bye-bye.
Bye-bye.